Hi, I'm David Schenk. I'm an attorney and enrolled agent, enrolled to practice before the IRS, and I talk about tax issues, estate planning, and asset protection. Today we're going to talk about, can the IRS take your home? You're not alone if the thought of the IRS seizing your home sends shivers down your spine. So let's look at this issue. Can they really take your house? The technical answer is yes. But the realistic answer is yes, but they probably won't. The IRS isn't like most creditors. Most creditors, like a bank or a credit card company, if they want to take something of yours to satisfy a debt, they have to go to court and get a court order, and generally the IRS doesn't. If the IRS wants to garnish your wages or levy your bank accounts, they just send a letter to your employer or your bank and it's done. But homes are different. Before the IRS can seize your home, they do need to get a court order. And that means that there's going to be a hearing before a federal judge, and you'll get to tell your side of the story about how you and your family would suffer an undue hardship if the judge grants the IRS request. Also, the IRS doesn't really want to seize your home. Most people have a mortgage, so the full value of the home isn't available to pay off tax debts. And they have to sell it before they get any money. And it's just not easy for them. Additionally, many states have homestead exemptions that protect some portion of the home equity. So for example, in New York, about $150,000 of homestead exemption is available. And so if they seize a house and the house has $125,000 in equity available, they don't get anything because 125 is less than 150,000. The IRS much prefers to levy liquid assets, like your wages, your Social Security payments, or your bank or retirement accounts. They just get money. It's much better for them. But just because they don't want to take your home isn't to say that they won't take your home. They absolutely can and do take houses. But it's generally reserved for the worst offenders, taxpayers who try to hide assets, who repeatedly take frivolous positions on their tax returns, who have ongoing payroll tax issues, or have committed, in the opinion of the IRS, tax fraud. Of course, if you receive a notice of intent to levy from the IRS, since it's unlikely that they will take your house, they're probably going to take something. Just most likely something liquid. Under no circumstances do you want to ignore a notice of intent to levy. Wait a minute, I hear some people thinking. You just said the IRS won't levy my house, but they just filed a lien on it. Well, a lien, although it sounds similar, is a very different thing. It's better than a seizure, but it's still not good. A lien is a legal notice that the IRS can file, and they usually do this with the clerk of courts in the county where you live, although in some states it's filed at the state level. It notifies all creditors that the IRS is taking a security interest in all of your property, and not just real estate, all of your property. Once the IRS files a lien, you generally can't sell the property, refinance the property, or do most financial transactions involving the property. But you can still live there. The IRS isn't seizing the property when they file a lien. A tax lien isn't a good thing. It places all kinds of limitations on you, and it's going to ruin your credit rating, but it's much better than a seizure. If the IRS is levying your assets or garnishing your wages, whether it's your bank accounts, retirement accounts, your house, your car, your Social Security check, your paycheck, or any other asset, there are steps that you can take. And note that I have individual videos on each of these programs. So one thing that you can do is you can simply pay off the debt. If you have the money or can get the money, paying the debt in full obviously will stop all levies and garnishments, and the IRS will also lift any liens that they have filed against your property. Another option is to file a collections due process appeal if you're within the appeals window. This is an IRS internal appeals process. It's only going to be available to you relatively early in the process. But they're going to pause any collections activities while your appeal works its way through the IRS process. You can also set up an installment agreement. Once you've established an installment agreement, all collections activities are going to cease. However, any liens that the IRS has filed are going to remain in place until the installment agreement is paid in full, or until you get the lien released some other way. You can ask for currently not collectible status. If you can demonstrate to the IRS that you can't pay your basic living expenses while at the same time making payments on your tax debt, you can be put into currently not collectible status. But be aware that the IRS's ideas of how much you need for your basic living expenses is quite low. For example, the IRS says that if you are a single taxpayer without dependents, you can live on about $1,200 a month. I don't know a lot of people who can live on $1,200 a month. You can also file an offer in compromise. An offer in compromise is a formal offer to the IRS to settle your tax debt for less than the full amount. And while they are considering your offer in compromise application, they're going to stop all collections activities, and the process can take from a few months up to as much as 2 years. Additionally, you can file for bankruptcy. When you file for bankruptcy, an automatic stay stops all creditors from any collections activities, and this includes the IRS. If you have a substantial amount of non-tax debt, this can be a really good option. But not all taxes are dischargeable, and it can be tricky to figure out which ones can be discharged. I have a video on this issue as well. If most or all of your debt is taxes, an offer in compromise is often a better choice. Or you can file for innocent spouse relief if your situation qualifies. If you are or might be an innocent spouse, the IRS is going to cease collections activities while they consider your application. And finally, check to see if you are approaching the 10-year statute of limitations, which is the limit in which a tax is collectible. You might just be able to wait them out. However, it can be a little tricky to determine exactly when the 10-year statute of limitations is up, because there are many situations that are going to toll or suspend the running of the 10-year limit. Disclaimer: this video and any accompanying text is for informational purposes only. The information provided does not and is not intended to constitute legal advice. No attorney-client or similar relationship is formed. If you require legal advice, please contact an attorney or other legal professional. This video covers a complex legal area in just a few minutes, and of necessity leaves out much of the detail. Don't make decisions based only on this video.